Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $390 million in assets, serving clients in 31 states. Indiana offices are located in Anderson, Fishers, Lafayette, Rensselaer, as well as Sonoma County, California, and Bozeman, Montana. This show is for educational purposes, and you are strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 1-800-928-4001 at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Ken Dilger.
And we are happy to have you along. Hey, if you're new to the program, I need a favor. We have a podcast that goes along with this show. It's called Consider This Program. You can find it anywhere that you listen to podcasts, and here's why you ought to sign up. Many of you in Central Indiana will know the name Joni Michaels. And Joni is going to be a new part of the show through over the course of the week. We will take a couple of the conversations. If you, when you listen to the show, there's usually 4 conversations, and then Ken and I do a wrap-up. But she's going to take a couple of those conversations and kind of interview me over what is going on. So you get a little bit more than what you can get on the radio. Obviously, some links, some things you can download. So go to where you listen to podcasts and put in Consider This Program. Now, I get asked all of the time, Ken, how in the world I can come up with enough content to do this show for 20 plus years.
I can see that.
And and if I was a radio host, I could understand that question too. The reality is I've been taking care of people for 31 years. And what generates most of the conversations that you and I have on the phone, or you and I have on the radio, are something that somebody's either emailed us a question, called with a question, or it's something that we saw that came out of a meeting that previous week. Mm-hmm. And, you know, some people say, well, yeah, but there's how many different things can happen? Well, that is the whole reason, in my opinion, and we're going to talk about this in one of the conversations. It's the whole reason why you really need a fiduciary in your life. It's the nuances that we don't catch. And so you and I have talked about the Eisenhower principle on multiple occasions. That's where you have things that are urgent that always get taken care of because, you know, the baby's crying and, you know, and it, you know, you got to mow the yard.
Right.
Right. And then there's the important. That's taking care of the foundation. And nobody cares. Most people, don't work on the foundation until it cracks. And suddenly the important becomes wildly urgent and important. Right. And that's what happens in the financial world. The problem is most of us just don't know when one of those issues is getting ready to arise. You can't necessarily see the foundation cracking in your financial future. So the things that we talk about on the show are things that I try to use to encourage you to pick somebody, to pick a team. I try to tell you the questions that I would ask. You know, a shopping list, if you're going to hire an advisor, if it's not us, here's what I would be asking. If you want that shopping list, just shoot us an email. Consider this at yourlifeafterwork.com. Ken and I are going to take a break. We're going to get right into the show. But give us a call, 800-928-4001. We'll be right back.
Hi, I'm Ken Dilger, co-host of Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group, and Joe's passion is teaching people about their money so they don't make inefficient financial decisions. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $390 million for families in 31 states. Join Joe and me as we address your questions about money and 5 critical elements of finance: retirement planning, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. Each week, we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 1-800-928-4001. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SBIC. You can find out more at our website, yourlifeafterwork.com.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Ken Dilger.
Happy to have you along. Hey, Ken, I'm betting you got a pair of sunglasses.
Yep.
We drive a lot,
Yes.
so we have to kind of have sunglasses. What tint is yours?
I think mine are probably just your standard black.
Yours are black, okay. Mine are yellow because I'm a golfer.
Yep.
Actually, I'm a hacker. Let's not even insult the game and call it golfing at this point. Hopefully it'll be better this year than it ended last year. But mine are slightly yellow to help illuminate the undulation of the greens. They were specially made that way, and it also helps with nighttime driving. You know, at 52, I do okay seeing during the daytime, but headlights at night really
get the halo effect at night.
Man, they really start to get me. And I learned that back in the old motorcycle days of wearing the yellow glasses at night because you had to have something to cover your eyes, or at least you should have. So why am I talking about sunglasses? And the big psychological word is cognitive bias. And it essentially means this. We all see life through our own lenses, through the way that you want to look at it. And I had the honor and privilege of being able to teach at Purdue University in Lafayette for 7 years, what I like to call 14 semesters. And, 5 of the 25 people on our team came out of those classes. So I was able to handpick great people that are able to be here. That was one blessing that I'm very grateful for. The other one was learning to start over 14 times because you forget what you don't know what you don't know, and I don't know what you don't know. It's the double course of knowledge. But I started every class the first day at Purdue saying this. If you're from Indiana, you know there's 3 things you're not allowed to talk about.
What's that?
Right? You're not allowed to talk about religion. You're not allowed to talk about money, and you're not allowed to talk about politics.
True.
Right? And I said, just so y'all know, I'm a Christian conservative that manages money, right? And you would see these eyeballs and these students going, Professor, you can't do that. I'm going, well, I just did it, right? And here's why. I have friends that are not Christians. I have certainly friends and people I work with that are not conservatives. And I have a lot of people in my life who don't manage money. The reason I tell people those 3 things is simply to understand the lens with which I look at life, right? When, as a fiduciary, my job is to treat your money as if it were my money and we were in the same situation. The challenge is some of that is black and white and some of that is opinion and gray. So if you don't know where my opinions come from, you won't know where my biases lie, right? And you could find somebody that's on the opposite side of the trade. I have very good, dear friends who use mutual funds. I don't get it. I don't understand it. They can't win with the evidence, but they're so committed to that they continue to do it, right? But you need to know my lens as to why I don't think people ought to use mutual funds and they should use exchange traded funds. And I listen to their arguments on the other side. But the point is we get into the biases. Now, from the Christian perspective, I'm not going to preach. There'll be no Bible verses today, but I will tell you that I attend a church called Northview, and it's based in Carmel, Indiana. And I think Pastor Poe did one of the best sermons that I've heard in a long time. The whole series is called I Quit, right? And the one that was this week was over pride. And people ask me what separates people from their retirement, and I will always tell them, well, the IRS is number 1. But number 2, Ken, the thing that will separate you from your retirement the most, in my opinion, is yourself. And it's 2 feelings and 2 emotions, if you will. It's pride and it's fear, right?
I get that.
So when people come in, so now you've made the move to come in and you sit down across from me. A very common question that I get is, how am I doing? Right? How am I doing? And what you're really saying when you ask me that, Ken, is compared to other 48-year-olds, right? How are me and my wife stacked up against the field, right? Give me the scouting report.
Of course.
Tell me how it is I'm doing. And I've always got to walk people off the ledge.
I'm sure.
I've got people that come in that are 48 years old, that's Ken's age, that have $5 million in accounts, and I've got people that have not started saving 1 iota, at 48 when they come in to see me. It's why we talk about those 3 different phases of finance that have nothing to do with age. you start accumulation when you start saving. That could be at 48, it could be at 18. Hopefully it's before 48, but that doesn't always work out that way, right? We have resets in our lives. So what should you consider as you hear me talk about this? Well, the first one, remember I told you there were two issues. The first one is the fear of making a wrong decision. Right? So there are people who want to take care of their own money. And then there's people who really don't, but they just don't want to get took.
Mm-hmm.
Right?
Right.
You've heard the stories of Shrinker who jumped out of the perfectly good airplane, or Madoff, right? And you've heard of people who've bought things that they wish they hadn't have bought. And boy, do I understand that. And again, it's why I created that checklist. If I were going to hire me, here's the questions I would ask me, right? And it's, I'm a Reagan guy. Trust but verify, right? I mean, if somebody tells you they can do something, great. Show me, right? Where do I go back to be able to get this? So I'm going to encourage you to try to get rid of that fear factor, if you will, eliminate it. And then some people tell me, Joe, it has nothing to do with fear. That is not at all why I'm still doing this on my own. And if that's the case, God bless. Now, the second issue then gets back to that pride, and I see it in two parts. Either people are afraid that they don't have enough to talk to us, that they're 48 and they've only got $250,000, or they're 48 and they've got $5 million and don't want to admit to it because they inherited it, and they're trying. I've got people who have a lot of money that you would never know because it came in ways that they didn't necessarily appreciate it. Car wrecks,
Right.
life insurance, and so they try to live a life where it's not there. So pride can be either trying to cover up what you have because it's a lot, or because you think it's not enough. And what I would tell you and encourage you is don't let that stop you from making wise financial decisions. The reason we built the Financial Enhancement Group the way we did is so that we can help people essentially regardless of the asset base that they have. Most of the people who come in have between $750,000 and $1.8 million. That's fair. That's who ends up calling me on the radio. We've got people with 5 times that amount of money, and we still have people in our church, that have $30,000 to $50,000 and just need a little direction. And that's why we have a team that are happy to be able to help. Here's the scoop, folks. At the end of the day, we're all going to have to live up to the decisions we made. Some results in our lives show up quickly. Drunk driving. You can have an immediate life change, right? Quitting your job without another one to go to. But other ones are going to show up slowly, like not working out. Ken and I talk about going to the gym all the time. I failed this morning. I got behind on my schedule. It's not going to kill me today.
Right.
But I can't keep doing that, or I'm going to be one fat guy. So not working out or not allowing fear or peer pressure to keep you from getting the answers and nuances about your money that can make the difference between a good and great retirement. And that's what I see happen is everybody is walking around and we're in this herd mentality, and so many people are trying to do this on their own that you don't want to be the one that says, I need help. And I'm telling you, from a prideful standpoint, that is going to cost you part of the retirement love that you want later on. It could be the difference between an okay retirement and a great retirement. Hey, you're listening to Consider This. I'm Joe Clark along with Ken Dilger. You got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com. Ken and I'll take a break. We'll be right back. Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. Over the past 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share with you that process that we use to protect over 700 families and more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry 2 weeks before the crash in 1987. I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the IRS. You can reach us at 800-928-4001 or consider this at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Incorporated, member FINRA, SIPC. Again, that number is 800-928-4001, yourlifeafterwork.com. Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Ken Dilger.
Happy to have you along. Ken, thank you for being here, buddy. Ken plays the average Joe, as you know. So he's supposed to ask me the questions that when I get caught in the minutia of the financial services world and start using words that are not germane to everything else in life. And boy, is it easy to happen. There are some things that you just get so used to talking about. You throw around acronyms and everything else. I did a talk the other day. The majority of the people in the room were over 65. And somebody told me I used too many acronyms because I used RMD and QCD. So QCD is Qualified Charitable Distribution. It's relatively new. RMD is that requirement to take money out of your IRA. So if you hear me say that, I want you to understand what it is. Now, Ken, when you lose somebody close enough to be a named beneficiary, right? The technical word for that is a designated beneficiary, by the way. So you need to know what that word means. So we've identified Ken. When you lose somebody close enough that you're the beneficiary, the last thing you want to do is to worry about money, taxation, and IRAs.
Gotcha.
Right?
Yep.
That is not the first thing that's on your mind. And it has to be one of the first things that's on our mind. We have a checklist that we go down. And if you were live in Radio Land right now, I would show you the 30 modules that we have developed. I'm part of Ed Slott's Master Elite IRA group. And here's 30 different modules that we go through when somebody dies to what's called inherit an IRA.
Wow.
If I showed you the modules, if you were here, you would see 7 of them are gray right now. And what that means is our CPA team, our tax attorneys, and people like me and other of my friends that are in the network are going through and updating those modules because something that changed in the 2017 tax code made those modules need to be updated. And yet most people have no idea that that has even occurred. So the question is, what happens when you inherit an IRA? And I will tell you, more bad things happen than the public knows. And part of that, Ken, as we just said in the last conversation, part of that is the difference between a good retirement and a great retirement. If you could have done something that was better, but you didn't know that better existed, you don't know you did anything wrong. Right?
Yeah, true.
Now that's
so
kind
true.
of that's kind of a tongue twister.
Right.
But if you stop and think about it, you don't know you made a mistake if you didn't know you had an opportunity. Right?
Correct.
So I'm going to walk you through a couple of the issues that happen when you are when somebody dies. The first thing that you do is make sure that you do not touch the money. Now we're talking about IRA and retirement plans, right, Ken? So something happens to your wife, something happens to your parents, and it's in an IRA, you do not touch the money. You pick up the phone and you call Joe. I mean, that's just the basic rule of life. Call somebody who knows what the heck they're doing. So many of you out there in Radio Land have bought annuities. Not because we sell annuities at the Financial Enhancement Group, but we have people who have heard us on the radio and say, hey, I want to move my money to the Financial Enhancement Group. Will you help me with this annuity? And the answer is, of course. And so it's got our name on it. So 3 years ago, somebody that we'd taken care of for over 20 years passes away. It was one of those cases, and we always try to meet your beneficiaries. I try to know who that person is next in line. But in this case, the daughter was out of town when I was dealing with her parents most of the time, moved back to town, married a guy who knew more than me. And one of the annuity companies, and he happened to have the annuity in an IRA, one of the annuity companies sent them a letter to their house as the beneficiary and said, hey, by the way, you are the beneficiary of, it was about $200,000, right? So new hubby looks at new wife and goes, hey, we can pay off the house, right? And nobody calls Joe, right? Remember rule number 1, call Joe, right? Nobody calls Joe. So the next thing I know, I get this letter from the annuity company that says the account's empty. Okay, it's their money, that's fair, right? And so we call him because we have another $250,000, Ken, sitting inside of a brokerage account, not an IRA account,
Okay.
that is absolutely 100% tax-free, right? Because they got a step up in basis on it.
Correct.
When Dad died, right? Now, I have no problem with them paying off their house. It's their money. It's their choice. Here's the challenge. There's no do-over on this. When they took the money out of the IRA, you cannot do a 60-day rollover with an IRA. There is no if, ands, or buts. Once you put your fingers on the money, it is out of the IRA, fully taxable. And now new hubby is livid that he has to pay taxes at a 26, 27% rate.
Ouch.
Because that whole $200,000 that was in the IRA that they decided to take out without calling Joe is 100% taxable at their marginal rate on their tax return on top of the other income that he made, right? And somehow that's our fault, right? And so,
it's like a mortgage guy. It's always our fault.
It's always our fault. No, and it all worked. I mean, it didn't work out okay. They had to pay the taxes. There's nothing I can do. There is no magic thing here, right? They had to pay the taxes. My point is this: you need somebody who understands how this works, because you've got to go through proper titling and then proper transfer. And Ken, there is a huge difference between when you're a spouse and when you're not a spouse, right? So if something happened to you, your wife's same age or younger?
She's older.
She's older. So if something happened to Ken, his wife, if she happened to be over 59 and a half, would almost always, and in my case I would say always, roll the IRA money into her own name.
Mm-hmm.
As a spouse,
Okay.
she can do that. Now, why is the key thing at 59 and a half? Well, in an inherited IRA, there is no 10% penalty. In fact, Ken, even at your age, even at your daughter's age, if your daughter was your beneficiary of your IRA, if something happened to you, she has to begin to immediately take money out that required minimum distribution. Because you're under 70 and a half, she gets to take it out over her lifetime, which is a benefit, if you will. But again, you had to lose Dad to get that done, right? The point is, you have that required minimum distribution if it's not a spousal rollover. So if your wife doesn't need the money, then you automatically roll it into a spousal IRA, so it becomes hers. But if she does need the income, which we see happen a lot, you leave it as an inherited IRA until the spouse reaches 59 and a half, and then you make it her IRA, or what we would call we do a spousal rollover. Keep in mind, you cannot go backwards. So you can't go from I made it my own and now I'm going to take it back to an inherited. That doesn't work. We see people try that all the time, and the IRS kind of chuckles when they impose the 50% penalty. And notice, yes, I did say 50. That penalty is what you pay if you don't take a required minimum distribution. So yes, if you were supposed to take $1,000 out and you didn't, welcome to a $500 fine.
Oh, yikes.
Yikes, yeah, it's not a...
That's huge.
It is the largest penalty that's inside of the tax code. So I've had people who've had trust where attorneys have told them that it's okay to leave your IRA via your trust to beneficiaries. I disagree, but I'm not an attorney. More on that in a private conversation. What I will tell you is if you fail to get a charity out, you're going to blow what we call the stretch. It's not going to be over your lifetime expectancy. It's taxed over a 5-year period of time. There's so much on this, guys, that I could just talk forever. The key thing is to call
Joe.
800-928-4001. All jokes aside, you don't have to call me, but find somebody that knows what to do with an inherited IRA before you make a mistake. 800-928-4001, yourlifeafterwork.com. Ken and I'll take a break. We'll be right back.
Hi, I'm Ken Dilger, co-host of Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group, and Joe's passion is teaching people about their money so they don't make inefficient financial decisions. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $390 million for families in 31 states. Join Joe and me as we address your questions about money and 5 critical elements of finance: retirement planning, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. Each week, we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 1-800-928-4001. Financial Enhancement Group is an SEC registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SBIC. You can find out more at our website, yourlifeafterwork.com.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Ken Dilger.
Happy to have you along, Ken. And you too, out there in Radio Land. Truly enjoy you taking the time to try to learn a little bit about your money. So, Ken, do you cook?
Well, Joe, that's a good question. If you ask my wife, she would say no, but I'm more of a griller. I man the grill on a monthly basis in the summertime.
On the monthly basis. So
Weekly basis.
Okay.
Well, we try not to eat a lot of red meat.
Yeah.
In the end, it's kind of hard to get away from the steaks and the pork chops. And
it
all
is,
that stuff, but
especially if you have neighbors.
True.
Yeah,
so true.
They come they come to visit. So I've cooked a lot. In fact, one of those things that people don't know is I used to have a cooking show, and I had the cooking show to teach you about your money. You know, at the Financial Enhancement Group, we take care of people who don't want to worry about their money. Right, so I'm very proud of you for listening to this show. If you don't want to take care of it, it's usually when something's going on in your life and you know you need a little bit of help, or the radio just happened to be on and you heard my voice, and here we are. But I did the cooking show because I wanted to explain to people things that they cared about that they could then maybe understand in their money they needed to care more about. Right, like salt, for instance. You have the nasty salt that's on your table. You have sea salt that's great for finishing. You have kosher salt that's great for pulling out flavor that's not full of iodine, right? And it's just like in your 401k. You have different accounts that you can invest in. They may look similar, but they are really different. And you don't just say, I'm going to divide it 1/3, 1/3, 1/3 any more than I would do the salt if I was making a dish, right? Hence the cooking show. But what happens every now and then is you get so focused on cooking one thing that you forget something else entirely. You either let it burn, or you forget to put on boiling water, or you forgot you were supposed to, do this or get something out of the freezer. We get focused, and what I call that in the financial world is silo investing, silo thought processes. I'm so focused on one thing, I forget on the other, which is why I'm a checklist creator. We live and die by checklist at the Financial Enhancement Group. So if you like to read, and you want to know more about Checklist, I would strongly encourage you to read Checklist Manifesto. It's one of my top 5 favorite books. Clearly changed the way that we function at the Financial Enhancement Group. When you think about Scully, who landed the plane in the Hudson, when he went on the Today Show and wouldn't take credit for it,
right? And
they thought he was trying to be arrogant because he wouldn't take credit for it. He explained we land the plane via checklist.
Right.
Now, who would have thunk, right?
Yeah, true. Even in the water, I guess, too,
but
right?
that's how much the checklists work. So when you prepare for your life after work, it is easy to get caught in looking at life in an individual component or time slot. And we will bring in our own logic, or what people tend to do is to bring in their own logic to satisfy the direction that they want to go for that independent decision, right? What I want you to be able to do is to think about this collectively. So we do our best to use 2 different checklists. One is to ask you what stage or phase of finance are you in? Are you in accumulation, preservation, or distribution? That's 1. And then 2, we bring out the fiduciary focus to make sure that you're paying attention to the 4 categories that you really have to be aware of: risk and volatility, fees and expenses, taxes today, tomorrow, and real return. So with those done, let's just run through this real quick, Ken, and in terms of what I would call the ingredients to a healthy retirement, right?
Okay.
If you were going to cook up a dish. 1 is savings, right? You got to have some money. If you don't have some money saved, it's not going to be a healthy retirement. It doesn't matter how well you cook if you don't have the meat, right?
True.
if you're trying to cook junk, it's not going to work. So 1, you have to have savings. 2, you have to have tax diversification. Now, what's that mean? Well, when you put money in your 401k that comes from your employer, that's called tax deferred. That's money that you're going to pay taxes on down the road when you need it or when you go to use it. Remember, everybody exits. All right, so you can either exit your retirement plan intentionally, You can exit it accidentally when the IRS says it's time, you're 70 and a half, or your heirs can deal with it. But we all exit, right? So one is tax deferred. The second is tax free. You may have a Roth option in your 401k, or perhaps you have a Roth IRA. That's money where you've already paid the taxes on, but you never have to pay the taxes again. And then last but not least is a normal, what we call a retail brokerage account, or a CD or a checking account. It's money that you've already paid taxes on that's sitting over here in the side. So you've got savings, you've got tax diversification. Then you want to go back to where's your focus. That accumulation, preservation, and distribution conversation is so important that I actually put together a video. It's on our website. If you go to yourlifeafterwork.com, you can find the video and get that information just to understand the different objectives that you have in each of those three stages. I've done many radio shows on it, written newspaper columns on it, so there's plenty of stuff that you can find on our website, again, at yourlifeafterwork.com. Now, you may have a defined benefit, and in America, almost all of us have a defined benefit plan.
Which is what?
Defined benefit is what most people would normally call a pension, right? You worked at Lilly, you worked there for 30 years, here's how much money you made, you retired, Lilly's going to give you a paycheck. That's a defined benefit. Social Security is a defined benefit for all intents and purposes. You don't see what happens in the back room, you just get a monthly check when you finally go to retire. You may have a defined contribution plan. That's your 401k, or a 403b if you're a teacher or a nurse. So you've got to have those factored into the deal. You may or may not have an inheritance that you have to deal with. And so, you've got all of these pieces, and so something happens to dad, and the attorney calls and says, Ken, by the way, this is now your trust. And people, countless times in my career, I've seen people make decisions based on that trust without regards to the other 6 things that I'd already brought up, right? And you've got to be able to go back and say, oh, no. Here's how these pieces fit in order to create a coordinated puzzle. Now, item number 6, by the way, is the spouse assets have the same 5 issues as above, right? And
True, yeah.
Here's Ken and his wife, and they both have 401ks, and somebody has helped her allocate her 401k, and somebody's helped Ken allocate his 401k. But when we lift the hood, let's say that you've got a great growth fund in your 401k. It's a mutual fund, which I don't like, but it's a great one that makes a lot of sense. And hers stinks, right? But she's got a great bond fund, right? And what happens is, because we looked at hers as a silo and we looked at yours as a silo, you have got a subpar bond fund. She's got an excellent one, right? But the two shall not match. And what we do at the Financial Enhancement Group is say, hey, let's get rid of the silo. Let's put these together. We're going to have more money in fixed income in hers, more money in growth in yours, because it's not your 401k and her 401k. It's your all's retirement, right? It's the Dilger family and how they get to come together. And then last but not least, eventually you're going to enter that world where you understand that it is not about income, but it really is about replacing your standard of living, right? It's not about assets, rather. It's about income and replacing the standard of living. And that is a huge shift. How you take care of money when you're managing it for the asset is entirely different than how you manage it for taking care of the income. We're going to talk about that in the next conversation. I'm even going to give you an example. One of my friends reminded me, had a really bad year last year, and he reminded me, he said, Joe, make sure that you remain humble while it's still an option. 800-928-4001. I would say the same about your retirement plan. Let's take care of it before it's too late. 800-928-4001. We'll be right back. Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. For the last 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share that with you, what we use to protect more than 700 families, more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry before the crash in 1987, and I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and as a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the Internal Revenue Service. You can reach us at 800-928-4001 at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group Incorporated, member FINRA and SIPC. Again, that number is 800-928-4001, and you can reach us at yourlifeafterwork.com. Well, good morning and welcome back to Consider This. I'm Joe Clark.
And I'm Ken Dilger.
We are happy to have you along, very, very, very much so. Ken, do not believe everything you hear.
I agree with that.
Do not believe everything you remember.
That's interesting.
So when I was 5 or 6 years old, my dad hit a dog.
With a car?
With a car.
Ooh, yikes.
I remember it very, very well. Dad died when telling you that it was a cat. Okay? Now.
Must have been a big cat.
My brother was too young to know. My mom doesn't remember the incident, but it was one of those rules that I put into my life that you can't always count on what you remember, right? So either Dad was wrong or I was wrong, but somebody was wrong,
right?
I mean, there's no cat dog, right? So don't believe everything that you remember. Now, that's maybe a funny story, but here's the reason why that becomes so critical. I've been in this industry for 31 years. And I've got things that I remember from the day of my CFP training and going through the board. Tax codes change. Right? Investment products change.
Yep.
Right? And so I remember making decisions, but what I have to be very, very aware of is that sometimes those decisions were made on a different playing field. Right? The decisions that I made in 2000 when it cost me $300 to buy or sell a stock are different than the decisions that I would make today when it cost me $6.95, right? Not $300. Right. The products that I would have used in 2000 when there really weren't exchange-traded funds that were readily available are different than I do today when they're more than readily available. When I look at the tax code and tell people you can't give money out of your IRA, well, that was true until it wasn't, right? Now you have the QCD for people that are over 70 and a half.
Right.
So don't believe everything you hear. Don't believe everything that you remember. Don't believe, and this one's tough for me because I'm opinionated, don't believe everything you think.
That's a good one.
I sit down and have very challenging conversations with people who don't think like I do, because I want to cipher that out. We live in a world financially where we have principles that we go by. Adam and I call it no heavy breathing. When the Dow falls 1,000 points,
right,
or the market's up 10%, we have to have a discipline, and that discipline can't be based on the emotions of what's going on at the time. And so we have to have these principles that we follow. One of them is that we challenge bad decisions, not bad results. Right? In every result, there is a modicum of luck. Right, and that's just the way that it works. When people say, "Hey, I built this business," or "I built that business," they had some good fortune along the way most of the time. What made them decide that they could build that business is a whole nother story, right? So, don't trust everything that you think, and don't believe everything that you're told. So back to Reagan: trust but verify, and remember when you go to do research to verify that Google is not data sensitive, not date sensitive. It is data, D-A-T-A. And what I mean by that is if you go read about the Roth backdoor on Google, I wrote much of that.
Really?
I created a lot
of
those concepts starting in 2007 when they first told us that we could, when there was no AGI restriction on doing a Roth conversion. And so I wrote a bunch of stuff that's out there on the backdoor Roth. I wrote it through Ed Slott's newsletter. I wrote it in the USA Today. There was part of it that made it to the Wall Street Journal. But you can go read it. I can't pull it down. And the problem is a lot of it's wrong. And it's not
10 years later, right? Or 12 years later.
It's not wrong because I was wrong. It's wrong because the tax code changed. Now, understand Google is data sensitive. So if I've got 6 inches of material that is all about the Roth backdoor or the backdoor Roth IRA, and I've written maybe 3 since the tax code changed December 17th back in 2017, right?
Right.
Those three are not going to be the first ones to show up. Because if you're studying the backdoor Roth, it's about recharacterization. And recharacterization on IRA conversions is not the same as what it once was. And so please be very, very careful when you read about stuff that says you can reconvert, even though I wrote it. You want to be careful. Don't believe everything you hear. Don't believe everything you remember. Don't believe everything you think. And don't believe everything you're told. Trust but verify. The question is, how do I verify it?
Good question.
How do I go?
Tell us.
And well, that's the answer. You've got to find experts
Right.
that
Call Joe.
That you believe. Call Joe. Call Joe would be a good answer. But understand, there's a reason I have 25 people on my team. When you call Joe, many times Joe's going to call somebody else.
Right. Of course.
It's I have a Social Security expert for a reason. I've got an expert in the annuity world for a reason. I'm part of Ed Slott's network for a reason. But my key thing with this, and I've got to walk you through this story to try to drive all of this home, is most of us wake up and we look at how much money we've saved and accumulated. And in an accumulation phase, that's a correct way to look at it. You're trying to save the right percentage of your income. You're trying to and you're trying to build tax diversification. When you get into preservation, and you go into that computer program and that says your trust has $1 million in it, or you look at your brokerage account or your IRA and it says you got $1 million in it, or $500,000, whatever's meaningful for you listening to the show. That's you're looking at an asset, right? The problem is you've got to convert that asset into income. And that's what we call a defined distribution. It's what I've spent my last 31 years of life trying to help people understand. The idea, the concept of a defined contribution plan, a 401k, a 403b, IRAs is great. I'm glad they did it. I think people need to have responsibility and they need to be able to take this stuff, take charge. However, I think they fail miserably in reminding you that you're going to have a defined distribution. Now that you've put the money in, how do you get it out? And that is amplified every time I log into my 401k, and it tells me as a professional money manager, Joe, here's how much income that you're going to have at 65 if you retire based on continuing to save what you're saving. And I look at it and go, and where is it coming from?
Right.
So in 2002, I got to go through this quickly, but I need you to understand it. In 2002, three brothers came into me and said, Joe, we need a check for $2,450 a month for the rest of my mother's life. They were doing what's called a life estate. I said, okay, I need $691,000. We put it in an account, and I can turn that into income to be able to get it. The best they could come up with was $651,000. Said, all right, we all understand the rules. It was 2002, Ken. Mm-hmm. Not a great time to start this, right? 5 months later, they're down to about $590,000. We have a come to Jesus meeting. The three brothers come in and they look at me. I'm looking at them and they're going, this is not going to work. We cannot lose 60,000. I'm going, just relax, trust the process. There's a difference between managing assets and managing income. If it wasn't the worst day, it was the worst week. But in October 9th of 2007, at the market high, older brother comes in. They now have about $890,000 in an account. Older brother comes in and demands I go from balance to growth. Right? Now, today, honestly, I would fire him. Back then, I had no choice, right? And I made the change. Worst possible day, right? By the end of March, they were down to around 490, March of 09, mm-hmm. right? Because the market just ate their lunch.
Right.
When you buy the worst possible day, bad things are going to happen. And here we are today. The account's back about where it started, right? And mom's never missed a paycheck. That is the difference between income and assets. When you buy an annuity, when you have a pension, assets are going to go up and down. If you're going to do this on your own, you're going to have to get used to understanding that, but develop the strategies to be able to get the income out in the most tax-efficient manner, and you're going to have to learn how to deal with volatility. And don't believe everything that you hear. 800-928-4001. Ken and I will be right back.
Hi, I'm Ken Dilger, co-host of Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group, and Joe's passion is teaching people about their money so they don't make inefficient financial decisions. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $390 million for families in 31 states. Join Joe and me as we address your questions about money and 5 critical elements of finance. retirement planning, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. Each week, we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 1-800-928-4001. The Financial Enhancement Group is an SEC registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SBIC. You can find out more at our website, yourlifeafterwork.com.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Ken Dilger.
Hey, I want to remind you guys that we've added Joni Michaels to the program, but not on air. That's me and Ken. On air, you will hear Joni and I on our podcast, which is called Consider This Program. Yes, you do have to put in program or you won't find it. We've taken the Consider This with Big Joe Clark podcast and changed it so that the technology would be better. There was an update that went on at iTunes, apparently. So consider this program. I think you will like it. Joni will take two of the conversations that we had today and interview me on them to get more specific where we're not restricted by time requirements for radio. So this is the conversation where Ken and I go through the four things that we talked about, and we quiz Ken a little bit just to see how his learning capabilities went. So
that's not good.
Well, of course it's good. So we started off by talking about cognitive bias and that we all have a lens. And so, Ken, the big thing there, and I won't even quiz you, but the two big things that you should get out of that I see that separate people from their retirement. The first one is always what?
Pride?
Nope, the IRS.
Oh.
The IRS is the first one. The second one is you. Right?
True.
And
so true.
And the two things that separate you from your retirement that you are responsible for are
fear and pride.
Fear and pride. So we have people that are fearful of, when they come to see us, they're fearful of making a bad decision because they've either heard other people have been burnt before, or they've seen other people, or they have been hurt themselves. Right? And what we do in our processes are our best to alleviate that fear. Everything is spelled out. It's laid out. It's very clear. Here's what we do. Here's what you do. And there's a reason for that. We want to eliminate that worry or that fear. Pride is the other one. We have people that are too proud to ask for help, and they try to do it on their own. And folks, the nuances of the tax code just make that tough. I mean, it's just, there's a bottom line. There's a reason I have 25 people on our team at the Financial Enhancement Group. And that's that I don't believe any one person, including myself, can do this anymore. There's just too many absolute moving parts. Second one was inheriting an IRA. So, Ken, here's the question. If your wife is under 59 and a half, would we do a spousal IRA or a non-spouse IRA where it was inherited?
Non-spousal?
Non-spousal. Because that way she would have access to the income, because there is no 10% penalty. Remember, if you inherit an IRA, you have to begin to take required minimum distributions out of it. And Ken, that's also true if it happens to be a Roth IRA. Now, they don't have to pay taxes. But they do have to take the money out. So with a spouse, you want to make sure, if they're over 59 and a half, you generally would want to roll it into their name, assuming you had the same beneficiary desires that were on there. The big thing here is it gets to be very, very complex, and you do not want to touch the money. Right? Once you touch the money, it is out of the IRA. So if you missed that conversation, you can go back and hear one of the many horror stories that I can give you. It'll be on our website at yourlifeafterwork.com. It was conversation number 2, and probably one that Joni will want to talk about a little bit more. When you look at inheriting an IRA, more and more of us are going to be doing it simply because of the age of the baby boom and because the fact that more and more of us have IRAs today. If you had a defined contribution plan, a 401k, there is a good chance there will be an IRA that comes from it at some point in time, because that's just tends to be where they go. So the directions that we had in the segment were, if somebody dies and you're the beneficiary of an IRA, call Joe. And I only mean that half kidding. Call somebody that really knows what's going on, because it is very easy to get this wrong. Then, Ken, we moved into silo thinking, where we talked about the 6 different ingredients of a healthy retirement. And the key here is to make sure that people don't get caught looking at one issue, Social Security.
Mm-hmm.
What do I do with an inheritance, right? So, Ken's in the mortgage business. So this is really easy, a real easy comparison, right? When people look at it from the 30,000 foot, they're going, one, can I make a payment? Two, can I get the mortgage to make the payment, right? Ken's
Can
looking,
I qualify?
yeah, Ken's looking at going, no, hold on. Let's see, what's your debt to income ratio? How much money do you have to put down? All of the things, the nuances, as I call them, that many people who are buying a home, especially for the first time, don't know that even matter, right? It's not one of those things that crosses their mind. And that's what happens inside of retirement. There are many pieces that come together, that have to come together in order to be able to make the correct decision financially. And when you can't see all of the pieces on the playing field, you've got a problem, right? I've always been fascinated with people who play chess without being able to see the board.
Really?
When somebody goes E2 or whatever,
yeah.
Those
are the really
and
smart
they can't
people.
see it. Yeah, they have too much time on their hands. That's all I'm thinking. No, but when you can't see the pieces on the playing field, you have to play at a different level. What happens when you don't even know what all the pieces are? And I think that's where people really get into trouble. And when we have these silo conversations, where people come in and they will ask us, should we take Social Security early or should we wait till 70? It's never as simple as a yay or nay answer. It's let's talk about all of these other nuances that you may have not even thought about. Then the last conversation was the difference between income and assets. And somebody asked me what drives me in this industry. And my why statement, which is what I get up to every morning, is to educate you about your money so that you don't make inefficient financial decisions that lead to frustration and devastation. I choose to continue to run the Financial Enhancement Group, where we take care of people who don't want to worry about their money so that you don't make inefficient financial decisions that lead to frustration and devastation. That's what really drives me. The heat of that, the driving force of that, though, is really the concept of defined contribution plans. It's 401ks and it's IRAs, where we gently as a society shifted the responsibility that my peers and colleagues had, and we handed it off to you. And though there's benefit to that on some hands, there's also challenges. And it's a very frustrating thing. 70% of the money in IRA accounts is not touched until people turn 70 and a half and they're forced to take it out. They're not properly using it for retirement because they don't understand how defined distribution works. And that's really what Ken and I went over in that show. It's when you shift from a standpoint of moving assets to where it's becoming income, you really don't want to do it in the form of a product, but you've got to do it in the form of a process. And you've got to understand how that works for you and your family, the good, the bad, and the ugly. Do not forget the risk and volatility, the fees and expenses, the taxes, or the inflation, or what we call real return. Hey, we got to take a break. You got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com, or give us a call at 800-928-4001. Ken and I will take a break. We'll be right back. Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. Over the past 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share with you that process that we use to protect over 700 families and more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry 2 weeks before the crash in 1987. I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the IRS. You can reach us at 800-928-4001 or consider this at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Incorporated, member FINRA, SIPC. Again, that number is 800-928-4001, yourlifeafterwork.com. Well, good morning and welcome back to Consider This. I'm Joe Clark.
And I'm Ken Dilger.
I hope you enjoyed what I like to call the fastest hour in radio. It amazes me every week as we go through this how many more things I would like to say than what I'm able to say, just because of the time constraints. So, as I said in the opening, if you are a podcast listener, go to wherever you listen to podcasts, iTunes or Downcast or whichever. Type in "Consider This Program." If you will, and subscribe, you'll be able to get the show automatically delivered to you, as well as a couple more podcasts during the week. I'm spending more and more time doing that. We're adding Joni Michaels to the show, where Joni will be able to come in and do some interviewing of us, not on the air that you will listen to on our stations, but you'll be able to listen to on the podcast. And it'll give me a platform to be able to talk a little bit longer or a little bit shorter, depending on the subject, to be able to get you into more detail. Ken, it was Valentine's Day this week.
Yep.
And you did?
You know what? We don't do a whole lot of stuff on Valentine's.
What happened?
I don't know. You're just too busy doing other stuff and trying to worry about the kids and homework and, and life.
It's one of those things that just kind of passes by.
It does.
And I don't know that that's necessarily a good thing. I don't like Hallmark controlling my budget. I don't like being pressured into doing anything. But as I go through life, the interesting part about being 31 when I got into the industry, 31 years ago rather, wasn't 31 then. I was just turning 21. Most of the people that I dealt with were at least 10 to 15 years older than me. Right? They were in their 40s and or mid 30s at the youngest. And so I've raised a lot of families, or watched a lot of families be raised, and I will tell you that you can't go back and make up for lost time.
So true.
You don't have to do things for Valentine's Day, but do find traditions, make them your own, and hold to them when you can. Because when I'm talking to my 90-year-olds with lots of money in accounts, it's rarely are they talking about their career. They're talking about their grandkids or great-grandkids, or going to the lakes, or those kind of things. So when you look at the show, Consider This Program, and you think about what we're trying to get done, our job, number one, is to educate you about your money so that you don't make inefficient financial decisions that lead to frustration and devastation. In no part do I want to encourage you to try to do this on your own. I just want you to be aware. For those of you who are wanting to do this on your own, blessings, good luck. For those of you that are looking for a fiduciary, that is exactly what we do. And we would be happy to take your call and sit down and have a cup of coffee with you and discuss yourlifeafterwork.com, the other critical elements that go along with retirement, including the tax planning. Those are conversations that we think are worthy. We've got 25 people on our team, and more than happy to be of assistance. Hope you enjoyed and got something out of the show. Remember to keep sending your questions and comments, yourlifeafterwork.com, or give us a call at 800-928-4001. Ken and I wish you a wonderful week. We will be back next week with more to talk about in your money. Have a great weekend.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 1-800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 2704 Enterprise Drive, Anderson, Indiana, 46013. Be sure to check out their website for more information at yourlifeafterwork.com.